Welcome back to Real Estate 101. Today we're going to continue our discussion on real estate law and talk a little bit about tax considerations on condo flipping. And I'm pleased to be joined by Eldad Gerb of Devry Smith Frank LLP. Eldad, welcome to the show.
Thanks for having me, Joe.
All right, Eldad. So I want to start today's show and I want to ask you, what are the tax considerations on the disposition of a condo?
So there's really three main ways the government considers the disposition of a condo or the sale of a condo, as it were. One, if it's your principal or primary residence, you don't pay any tax. So you buy a condo for $200,000, a few years later you move in, you live there, you sell it for $300,000, the whole $100,000 belongs to you. Another way to do it is if the condo is considered a capital property, so that's to say you bought like a rental property, then half of that $100,000 is considered as part of your income. What most people are being caught on is in this condo flipping is that 100% of the amount, because the government is considering or the CRA is considering that you're running a business, and even if you're doing one transaction that you're running a business, and 100% of the amount that you earned is considered part of your tax.
Okay, so let's say you sell one condo, one transaction. Is that considered running a business by the government?
You know, so the government has gone on record as saying even one transaction can be considered a business. So you can't look at it that somebody's doing many transactions as a business, and if I only do one, how can that be possible? The government has concluded, and it's been taken to the courts, that even one transaction can be considered running a business.
All right, so what does carrying on a business exactly entail legally?
So carrying on a business is a question of degree. So how much activity is somebody engaging in? Are they regularly going to the property? Are they always looking for new properties? Are they engaging with several real estate agents? It's difficult to answer the question without in the abstract. You really need to look at every person's individual facts, but really what the government and what the CRA is looking for is just the amount of activity surrounding the transaction to determine whether you are in fact carrying on a business.
Okay, so what are some of the tests that the government or the CRA will use to determine whether or not that, a person is carrying on a business in real estate?
So the government looks for three different tests. One is conduct, one is the nature of the property, and one is the taxpayer's intention. The easiest one to talk about to start off is the type of property. So take into consideration when somebody buys a mall. You know, just by the nature of the property, you're not buying it to flip. What you're trying to do is earn rents.
Cash flow.
Right? You're looking for the rents, that's your income. So when you dispose of that mall, it's just going to be considered a capital property. That's pretty easy. It's much more difficult to do that with a small rental property when somebody's buying a condo as part of Toronto's condo boom. Another way they can look at it is your conduct. They'll compare your conduct with an expert in the industry's conduct. So they're not comparing necessarily your transaction in isolation, but they're looking at your transaction versus how an expert, what they call how a dealer in the industry deals with the property. So if you did all of the things that an expert real estate agent did, you might be considered to be carrying on a business. The last piece is your intention. So the simplest way to describe intention, you have, God willing, 4 children and a wife, and you go out and you buy a 1-bedroom condo in downtown Toronto. Well, it's unlikely, based on the remainder of the facts, that your intention was to move into this condo. So they're going to consider it that you're in the business of flipping condos, and therefore you're going to be taxed on 100% of the amount you earn on that property.
Okay, so how many principal residences can someone have?
So the answer to that question is actually really easy, Joe, despite people wishing the answer was bigger. The answer is 1, and it's 1 per family unit. And the tax code is very specific in its definition of a family unit. It belongs to the taxpayer, their spouse, be that common law or an actual spouse, and any children who are unmarried under the age of 18, aka just your kids. Of course, once they go over 18 and they do become married, that enables a parent to help out those kids by them being able to move out and investing, and they can then have their own primary residence. And so that's great because, again, all of that money that they make on the sale of those condos would be tax-free.
Okay, so who is the CRA, if any? Who are they targeting?
So it's a little bit of a misnomer that they're targeting anybody, but the CRA's job is to protect the tax base. So they're looking at real estate databases, they're looking at condo developers lists, they're looking at condo registry lists, and they're just cross-referencing everywhere. So if somebody has assigned a property prior to its registration, or they have the registration lists, they're just checking to make sure that the names that appear on all of these registrations and real estate databases and Terranet and so on, actually that the transactions and the sales of these condos appear on these people's tax returns. The CRA sent approximately 1,000 or maybe even more questionnaires to people who bought and sold condos from 2005 through 2010 or 11 into the GTA area.
Okay, so for someone that's buying a condo and running it as a business, how is it taxed?
So you might not think you're buying it as a business. Let's take this example. Somebody walks in and has every intention of actually moving into the condo. But then, as is often the case, the condo is delayed and is not built in the time frame that they intended. And so maybe they rent it out and maybe they sell it on registration. Now, to get the principal residence tax exemption on any money they earn on the sale, they actually have to move in. It's not enough that they intended to move in when it was going to be ready. If they don't move in, all of that is going to be considered a business, and the government is going to expect that the GST rebate is going to have to be paid back, and 100% of that amount on a particular schedule on your tax returns is reported in full. So again, going back to our earlier example, if you bought the condo for $200,000, sold it for $300,000, the full $100,000 is going to have to be included as your income, and you're going to be taxed at your income tax rate. So typically on that $100,000, you're going to experience about 40 or 45% in tax. So $45,000 in that example.
So what is a taxpayer's rights?
So a taxpayer has a couple of options. The first thing is you can file a notice of objection. So the notice of objection will actually take your case out of the auditor's hands and to an appeals officer, and you should get an impartial second review of your file and the sale of your condo looked at by a new person. As another alternative, if you have a problem with your auditor as a service matter, that you don't think you're being treated fairly, that they're not looking at your evidence and your facts and your documents in a fair manner, you can complain right to the tax service office that auditor is in, or you can make a formal complaint to Ottawa. As a last measure, you can also go to the ombudsman to file a complaint.
Okay, Eldad, so for today's final question, what is the difference between tax avoidance and tax evasion?
Well, Joe, I'm glad you asked. I get this question a lot. Tax avoidance is completely legal. So the best way to do this is by way of illustration. If a man and a woman, or a man and a man in Ontario, or a woman and a woman, decide that they're going to get married before the end of the year, because not for shockingly just for love, but it's in their best interest for their taxes to file as a married couple rather than as two singles. If they do that on, let's say, December the 30th to take advantage of some tax loopholes, that's completely legal. We don't want people to do it. It is a way of tax avoidance, but it's completely legal because they did in fact get married. If the same man and woman or couple get married or do not get married, but write on their taxes that they have, now they're lying, it's a criminal act, and that's considered tax evasion.
Okay, Eldad, thanks very much for coming on today's show, and I'm looking forward to seeing you again sometime in the future.
Thanks very much, Joe. It was a pleasure being here. And if anybody has any tax questions regarding any real estate purchases or sales, please give me a call at the number on your screen.
Thanks, Eldad. So there you have it. If you're having any tax issues, get in contact with Eldad Gerb of Devry Smith Frank LLP. I'm your host, Joe Terceira. Thanks for watching, and we'll see you next time.